up, we're talking property strategies, including those for your SMSF. And I know a lot of you watching Ausbiz regular channel would be, self-directed. So from building wealth in accumulation phase, right through to generating income in retirement phase. That's what this next segment is all about. And for that, Andrew Grinsell from Cooee Wealth is joining us now. He helps clients navigate property inside and outside of super. Andrew, welcome. It's great to have you here.
Thank you. Great to be here.
Well, we can talk property inside or outside the super, but how does your advice differ depending on whether somebody is in accumulation phase, nearing retirement, or actually in retirement?
Yeah, absolutely. So people who are in accumulation phase and have got quite a time frame left to retirement can probably focus a little bit more on the capital growth element of property, whereas what we find is as people get closer to retirement, it's less about growing wealth, it's more about the passive income generation. Now, the properties that might have good capital growth characteristics, like residential property, might not necessarily be the best properties for somebody who's close to retirement or in retirement phase, because the net rental income or the net yield after your expenses like council rates, water rates, property manager, repairs and maintenance, strata if it's in a strata committee, can really bring down that net income, which can be challenging for people who are close to or in retirement phase, especially once people are retired, where they've actually got to, if they're taking an income stream, and if they want their superannuation to be in a situation where there's no tax on the investment returns, then we've got minimum pension payments that need to be met. So for somebody who's between the ages of 60 and up to 65, they need to draw out 4% per annum of the balance of their superannuation. Now, when we have a look across Australia, the average gross rental yield is closer to 3%. So if too much money's tied up in property, and by the time that 3% gets watered down to like 2% after expenses, we start running out of enough cash flow to actually fund those minimum pension payments. So in those sort of situations, we need to potentially be looking more towards higher yielding or higher income properties, but also having some more liquid assets to complement the property portfolio so that there's enough liquidity like cash, shares, fixed income investments that can be drawn upon to help meet those minimum pension payment requirements.
Okay, so you can't look at property in isolation. So let's break down some of what you've just mentioned. So we've got low vacancy rates for rentals. We've got housing supply not keeping up with demand. We also have competitive lending to SMSFs.
Absolutely.
So what is the strongest argument right now for SMSF investors considering property exposure?
Generally, it's the leverage. I mean, you're borrowing to invest in a bigger asset than what you might otherwise be able to buy if you were to just go in and use cash. So property allows us to borrow more. We generally need 20 to 30% of the purchase price to be available. The rest of it we can borrow to go and fund the purchase. So we've got more assets working for us. People also feel more comfortable with property. They understand it, it's physical, it's tangible, you can see it, you can touch it, you know it's there. Whereas for some people, they feel a little bit less comfortable with, say, shares or fixed income investments, where it's a little bit more of something that you're not exposed to every day. So people just tend to have less confidence in it. Each serves their place within a property, within a portfolio and within a retirement strategy. But that sort of that tangibility, that confidence, that familiarity tends to have people lean towards property. We're all for people investing in things that they have confidence in, because at the end of the day, you need a strategy that you have confidence in and you're going to stick to when there's the inevitable hiccup along the way. Markets get volatile, tenants leave, all sorts of things happen, but we feel more confident with clients who have got confidence in what they're investing in.
I feel as if we're talking a lot about residential property. Is that just by default, again, because most people are familiar with it, that's the go-to? Or are you adverse, I should say, to investing in commercial property, industrial, or other strategies?
No, we're quite fans of using industrial or commercial property for clients, especially as they are getting closer to the time where they need to be drawing an income, because the yields are higher. We're getting higher yields, more expenses are met by the tenant in a commercial property or an industrial property situation. So we've got a lot of clients who have invested into commercial property in their self-managed super funds, That could be just a property they've gone out and bought in the market to generate their retirement income. Sometimes we're seeing people transfer their business premises into their self-managed super fund. But in addition to that, we do work with a lot of clients who are investing via managed funds that have exposure to commercial or industrial property. And some of those are yielding sort of closer to 7 or 8% per annum income, which obviously goes a lot further towards meeting those minimum pension payment requirements that we have in retirement phase, which just can't be met by most residential properties.
And as we see lending rates become more competitive, as we see interest rates go down, perhaps not next week, as we've said before in this program, how much, or does that change the viability of property for self-managed super funds, or is that sort of tinkering on the edges right now?
No, absolutely, it does change the viability. Your holding costs are lower. So when we have a look at residential property for clients, we'll have a look at the capital growth rate that we expect on the property. We'll have a look at the net rental income, and that obviously is driven by the expenses, and interest is one of those expenses. So if interest costs are down, the total return is potentially higher. Not only that, it also tends to stimulate the property market, because when interest rates come down, serviceability assessments improve, people can borrow more money. If you give people more money, they will spend it, and that pushes property prices up. So it does have quite probably a two-pronged benefit, in that the asset itself can perform better from a cash flow perspective, but also property prices are more likely to be rising in a falling interest rate market.
Now, SMSF property, or property within an SMSF, as you mentioned, can sometimes fall short of those pension requirements. So how can investors balance that sort of property with more liquid assets to meet those income goals?
Yeah, so we do a lot of modelling with our clients around what the expected net cash flow would be from a property in the fund, and then we have a look at what's available, or how much we should balance between property and how much should then go into, say, shares, fixed income, even listed property. So we can invest in real estate investment trusts as well, which we can quite easily sell part of. Unlike a residential property, we can't just go and sell the bathroom. So we'll have a look at that and do a bit of modelling to figure out how long do we believe that the more liquid assets will last to allow the property to top up the income that's required to be drawn from the super fund before maybe the property has to be sold. In some cases, if there's enough money allocated towards those more listed investments, clients could actually, in some cases, be able to hold those properties right throughout retirement. In other cases, we do see them become forced sellers once the more liquid assets start to dry up. Trusts, private companies are often used to build diversified property portfolios. Can you just explain how those structures, and I know it's a big question, but how they help investors sort of manage risks and returns? Yeah, absolutely. So we are seeing a lot more people ask about investing in property via trusts and companies. So the idea is that a trust or a company is a separate legal entity to the individual. So therefore, if anything goes wrong, the risk can be limited to the trust or the company. However, in a lot of cases, there is a personal guarantee provided by the individual, so that can unwind some of the risk protection that people might have been after from the trust or the company. We're seeing a lot of people use trusts and companies for borrowings or for property purchases, because what happens with lender assessments is, in a lot of cases, you can get an accountant to sign a letter basically saying that the trust can look after its own cash flow. So rent covers expenses, we're fine. And that basically means that the bank won't count the loans within that entity when they're doing a borrowing assessment. So a lot of people are using trusts and companies to be able to maximise the number of properties that they have. However, it can come with disadvantages. So if we have a property that's owned by a discretionary trust, for example, if there is negative gearing on that property, so if the expenses exceed the income, that negative gearing gets trapped within the trust or the company. It can't be passed on to the investor. So a lot of people want to invest into property for the negative gearing benefit of it. When we go to a trust or a company, we lose a lot of that. We also run into issues with land tax as well. So in most states of Australia, the land tax exemption threshold, so the value of land that you can own within those entities before you start to incur land tax, is generally a lot lower than the land tax thresholds for an individual property investor. So we do see people start to incur land tax bills, which, New South Wales is 1.6%, in Queensland 1.7%, from lower values when they're using a trust or a company rather than having the property in their own name. So people have just got to be really careful around why they're using it. If it's positively geared, different story. If you're already incurring land tax in your personal name, maybe you're not so concerned, but if land tax is going to hurt, if the loss of negative gearing is going to hurt, really do need to have a closer look at whether or not those sort of entity structures are appropriate.
Amazing that you can just list all of those concerns. Really impressive, Andrew. So another sort of area I think that a lot of investors think of, particularly within SMSFs, is property development. But they do face restrictions, correct, under borrowing arrangements. So how in that case would managed funds provide sort of a solution? Yeah,
absolutely. So for context there, when there is a borrowing arrangement in place in a self-managed super fund, we can't change the underlying nature of the asset. So that means we can't go and turn a house into a duplex or townhouses into apartments, these sort of things. General repairs and maintenance, that's fine, but we can't really go and change fundamentally what the asset is. So for clients that are more interested into property development side of things, and just for context, we do have a property consultancy side of our business that does help with this, so we get a bit of exposure to it. These clients will end up investing in a managed fund where they're not the only investor in the managed fund. So it's like going in with other investors, and then that means that the managed fund is actually carrying on the property investment. Your self-managed super fund owns units in that trust and therefore gets its entitlement to the capital growth and the income generated from the property development activities, but the SMSF itself does not own the property that is subject to the property development, so it does allow for that property development exposure to be obtained through a self-managed super fund.
Okay. I'm really putting you through your paces here, so
That's
thank
all right.
you.
Go for it.
You often recommend a minimum SMSF, I was reading in your notes, of around 500,000 before considering direct property. Why is that the case?
It's interesting though, because I suppose we get more inquiry from people wanting to set up a self-managed super fund and buy property from people who have got lower super balances than we do from people who have got higher super balances. And I don't know if that's because people with lower super balances feel like they need to be doing more to catch up. But the challenge we have is that the costs of a self-managed super fund are largely fixed. So if somebody comes to us with $100,000, $200,000 in super and they want to go and set up a self-managed super fund to go and buy an investment property, we need to set up an SMSF. That comes with costs. We need a corporate trustee for the self-managed super fund. Most lenders will require it. We then also need another corporate trustee for the limited recourse borrowing arrangement. So we're looking at a few $1,000s worth of setup costs for the self-managed super fund. We then have the ongoing costs associated with that as well. So we end up with the annual ASIC fees on the two corporate trustee companies, and then the ongoing tax, admin and audit, which we see different prices from accountants, especially with property, ranging from anywhere from sort of $3,000 to $5,000 a year of ongoing accounting costs. So it could cost from $3,500 to $5,500 a year to run a self-managed super fund. So if somebody's only got $200,000 in super, they're already losing 1.5% just in costs in running the SMSF before we worry about going and buying a property. Now, if you've got $200,000 in superannuation and you want to go and buy a property, generally we need about 30% of the property purchase price. So what that does is it means that we're looking at maybe a property purchase of up to $600,000. Almost the entire superannuation balance is going to go into that property purchase. And then at $600,000, it's a tight market for investors. I mean, property prices, it doesn't allow you to get into a lot at 600. We're typically seeing people have to go more regional, more risky, but also, or alternatively, into strata title type properties where the expenses run high. If we get somebody with a bigger balance, we can sort of get to a point where maybe they can go and buy an $800,000, $900,000 property. The quality of that can be a lot better. The fixed expenses as a percentage of the super fund are a lot less, but they can also afford to diversify. They can still have a few $100,000 in a more traditional balanced or growth type portfolio, so that we're not relying 100% on property to do everything for the retirement savings strategy.
Yeah, and because leverage comes with risk,
Absolutely
inevitably.
It does.
So how do you help clients, I guess, determine the right level of gearing? I mean, I think you went a long way to sort of explain that within an SMSF, but do you have a rule of thumb?
It depends on what is needed to achieve your goals. So the way that we look at gearing is gearing can increase returns, but it can also increase risk. So we look at risk as being, if we look at it on a triangle, we have a client's risk tolerance, that is how much risk they're willing to take to achieve their goals. We have risk capacity, that's how much risk you can afford to take without it putting your whole financial planning strategy at risk. and then your risk need. So that's how much risk do you need to take to be able to achieve your goals. So we need to find the right balancing act between those three components of risk, and that helps drive the borrowing conversation. So if somebody's quite a long way off achieving their retirement goals, they might need to go for a higher loan to valuation ratio, pushing themselves up to that 80%. Somebody who's a bit closer to being on track might be able to pull that back down. They might be closer to 50 or 60%, maybe even lower.
We've had a couple of questions come in. I think we've almost answered them, but I'll just put them out there. On behalf of Tim, thank you, Tim. My SMSF isn't at 500,000 yet. How can I still get property exposure?
It can still be done. It's just going to come down to how much of the superannuation balance you're willing to commit towards putting into property, and what the investment time frame is, what sort of contributions are likely to come into the fund over time to allow either diversification or reduction of the debt. So it can still be done with a direct property purchase. Alternatively, we can talk about we can look at things like the managed fund structure that we spoke about. Now, that doesn't have to be property development. It can be buy and hold properties. We can look at real estate investment trusts if we're interested in getting exposure to things more like office, commercial, retail. There's opportunity to do that. There's multiple options to get that property exposure. It probably comes down to which one is most likely to help Tim get from where he is today to where he wants to be and what his goals are.
And what phase of life Tim's in, because we don't know that.
We don't know that.
I think that's Jason. I've got to start wearing my glasses. If I buy property in my SMSF, does that mean that I'm putting all my eggs in one basket? Well, not if you have other...
Depends on how much is left over, right? So if the entirety of the SMSF is property, and we see a lot of people who have got their home, then they've gone and bought a few investment properties outside of super, and then they start to get to a point where they've maxed out their borrowing capacities and they start going, well, where's the next place I can, or where can I get my next property? As if the goal is to accumulate as many properties as possible. And then they start to look at the self-managed super fund as a way to do that. Whereas we'd sort of suggest maybe you take a step back and actually think about, okay, why are you buying the properties? Like, what is it that you want these properties to actually do for you? And is adding another property inside super going to actually help you get to where you want to be, or is it going to work against it? Because in some cases it can work against it. Maybe you don't need to buy another property, or maybe you shouldn't because you've got enough exposure elsewhere, and we should be letting the self-managed super fund do something different.
Fantastic. Just one last one from me. So if we were to wrap this all up in a bow, because such good information, and you're thinking about property strategies within an SMSF, what is the smartest way to think about that over the next 5 years?
It's got to come down to what are your goals. The property, we see a lot of people see property as the goal. Property shouldn't be the goal, it's what the property is going to do for you. So the smartest thing anyone can do is actually think about, okay, 5 years from now, what would be a position that you would be happy to be in? And then work your way backwards and go, okay, well, what do I actually need to do to get from where I am today to achieve that 5-year objective? And then we find the strategy that best aligns with that.
Andrew Grinsell, Cooee Wealth Partners, thank you so much for joining us.
Thanks for having me.